Lesson 1, Introduction to GST. In this chapter, we'll discuss about the GST, that is Goods and Services Tax. Basically, we'll discuss the basic concept of GST and the common terms used under GST. So first of all, we'll start with the basic concept of GST. GST is an indirect tax which was introduced in India with effect from 1st July 2017. GST has subsumed many state and central taxes like VAT, excise, service tax, entry tax, octroi, and so on, and has paved way for single tax across the nation. Introduction of GST is a significant step in Indian economy as it has removed the double or cascading effect of sales tax on goods and services and has in turn led to the reduction of cost of goods. GST, as the name suggests, is applicable on supply of goods or services. GST paid on the purchase of goods and services can be set off against the output tax payable on the supply of goods and services. So, what is input tax and what is output tax? Basically, when a registered dealer buys goods from another registered dealer and pays GST on it, then it is termed as input tax. And when the registered dealer, same dealer, while selling these goods further will charge GST on it, it will be termed as output tax. One more term here arises is net tax payable. Net tax payable is the output tax, that is tax charged on output supplies, minus input tax, that is tax paid on inward supplies. This is the net tax payable to the government, and we can say that net tax is calculated on the mechanism of input tax credit, that is ITC. So basic mechanism, you can say backbone of the GST is its provision to set off input tax against the output tax. On the screen, you can see a tabular representation of calculation of net tax payable. Suppose a company has purchased 4 LED TV at the rate of 25,000 each, so the taxable amount is 1 lakh rupees. Tax charge on these goods is at the rate of 18%, so the tax amount is 18,000. Now the company sells 3 LED TV at the rate of 30,000 each and the taxable amount is 90,000. Percentage remains same 18% and the tax amount is 16,200. At this stage, the company's output tax, that is tax payable, is 16,200 and input tax, that is tax receivable, is 18,000. So net tax payable is output tax minus input tax, 16,200 minus 18,000, which is minus 1,800. As this value is less than 0, hence no tax is to be paid to the government at this stage. Next, the company sells another 1 LED at the rate of 30,000, on which it charges tax at the rate of 18%, that is 5,400 rupees. Now, at this stage, output tax is 16,200 plus 5,400, which is 21,600, and input tax is 18,000. So net tax payable to the government now is 21,600 minus 18,000 equals to 3,600 rupees. Next, we will discuss the common terms used under GST. Here first is GSTIN, that is Goods and Services Tax Identification Number. All the business entities that registers themselves under GST are provided with a unique identification number, which is GSTIN. GSTIN is a 15-digit unique number which is state-wise and PAN-based. The 15 digits of the GSTIN have their own relevance, and now we'll discuss basically the bifurcation of these 15 digits. First 2 digits of the GSTIN are the state code. Under GST, every state has been assigned a state code, and from the state from which you are applying for GSTIN, your first 2 digits of the GSTIN will be the state code. For example, the state code of Delhi is 07. So if you are applying for GSTIN from Delhi, your first 2 digits of GSTIN will be 07. Next 10 number is your PAN card. Then 13th digit is the number of registration within state. 14th digit is a default digit, and 15th digit is a check code to detect errors. So this is the complete bifurcation of the 15 digits of the GSTI. Next, we will discuss the GST registration type. Under GST, there could be various type of registered dealers. First is regular dealer. Most of the entities that register themselves under GST falls under the regular dealer category. A regular dealer can make interstate sales as well as local sales. Next is composition dealer. A composition dealer has to pay tax at a specific rate on total sales, and he cannot claim input tax credit, that is ITC. Basically, under composition dealer scheme, there are less formalities as compared to regular dealer, but not everyone is eligible to opt for composition dealer schemes. There are certain restrictions to it, like currently, if your turnover is greater than 1.5 crore, then you are not eligible to apply for composition dealer scheme. This limit can keep on changing, but currently it is set to 1.5 crore. Next is UIN holder. Unique Identification Number is a special type of GST registration done for foreign diplomatic missions or embassies. Basically, these bodies are not liable for taxes in India, and if they have paid any tax, then the same is refunded to them. Next term is government body. The government bodies that are registered under GST are liable to deduct TDS under GST law. TDS that they deduct will be at the rate of 2% on payment made to the supplier of taxable goods or services, where, please note, where the total value of such supply under individual contract exceeds INR 2,50,000. Next is IGST. Interstate GST is levied on inter, that is outside state transaction, and is collected by the central government. So whenever you are making an outside state transaction, interstate transaction, or we can say central transaction, then IGST is to be levied. Next is CGST, Central GST. It is levied on all intra-state transaction, that is within state transaction, or you can say local transaction, and it is collected by the central government. Next, SGST and UTGST. SGST, that is state GST, and UTGST is Union Territory GST. Both these terms are totally similar, with the only difference that if you fall under the state government jurisdiction, then you need to charge SGST, and if you belong to Union Territory, then you need to charge UTGST. So as both these terms are totally similar, we will be referring them to as SGST. SGST is levied on all intra, or you can say within state transaction, and it is collected by the central government. Let us understand these three terms, that is IGST, CGST and SGST, with the help of an example. A company located in Delhi sells goods taxable at 18% within Delhi, that is, it is a local transaction. In such a case, the company will charge CGST at 9% and SGST at 9%, which will make a total of 18%. If the company sells the goods outside Delhi, then it will charge IGST at 18%. Next is cess or additional cess. Cess is a form of tax charged, or you can say tax levied, in addition to the regular GST taxes. GST cess has to be levied on supply of certain notified goods, mostly belonging to luxury and demerit category, whereas additional cess is levied on certain items after levying of GST and normal cess. Government has categorized various items on which additional cess is to be levied. So if cess and additional cess are applicable, then first you need to apply the GST, whether it could be IGST or CGST, SGST, then normal cess, and then will be your additional cess. Our next term is input tax, that is tax paid on the purchase of goods by a registered dealer to the seller of goods who is also a registered dealer. Input tax credit, ITC, it can be termed as amount of input tax eligible for claim from the government. Not complete input tax is eligible for claim under certain conditions. So input tax can be fully claimable or can be partially claimable. Hence, the amount of input tax which can be claimed from the government is termed as input tax credit, or we can say ITC. Next is output tax, that is the tax collected on the taxable supply of goods or services made by a taxable person. Inward supply refers to receipt of goods or services. In general, you can say all the purchases made or services received are termed as inward supply under GST. Outward supply refers to supply of goods or services, and in general, you can say all the sales made and services given can be termed as outward supply under GST. Next is tax invoice. Any invoice in which tax is charged is called a tax invoice. It could be B2B, B2C, export, B2cl, and so on. So, any invoice in which tax is charged is called a tax invoice. Next is bill of supply. Bill of supply is issued by a registered dealer for supply of goods or services that are exempted from tax. Basically, if a registered dealer issues an invoice in which no tax is charged or the items are exempted from tax, then it is called bill of supply. In case of composition dealer, he will always issue a bill of supply and he is not eligible to issue a tax invoice. Next is B2B transactions, business to business transactions. These transactions are carried out between two businesses and not between business and end user or consumer. So basically, both the parties involved should be registered under GST. For example, a company purchasing raw material from some another registered company for further manufacturing of goods is an example of B2B transactions. Next is our B2C transactions. Business to consumer transactions, these are carried out between a business and end user or individual customer. Basically, you can say outward supplies to unregistered persons are called B2C transactions. Next is B2cl transactions. They are business to consumer large transaction where the transaction is interstate and invoice value is more than 2,50,000. You can say any transaction made to unregistered person which is interstate also and is exceeding 2,50,000 rupees will be termed as B2cl transaction. Next is exempt nil rated non GST. Exempt supplies are those that are specifically exempted from GST through government notifications and include non taxable supplies. Nil rated supplies are those that attract 0% GST, that is, tax rate charge on those items is zero. There is a very thin difference between exempt and nil rated. Exempt items are those that are exempted from GST under certain conditions or through government notifications. But nil rated supplies, or you can say nil rated items, are always taxable at 0%, or you can say they are totally tax free. Then is non-GST supplies. Non-GST supplies are those which do not fall under GST purview and can be taxable under any other local sales tax law. Basically, the items or supplies falling under the non-GST categories are to be shown in the GST reporting under the head non-GST supplies. Then is your export and import. Export transactions under GST are treated as zero rated supplies. It implies that exports in India could be of two types. First, on which no tax is charged, and another on which tax is charged, but the seller or you can say exporter will get full refund of the tax paid. So, in any of the case, export is tax free or you can say zero rated. Then is import transactions. Import transactions are treated as interstate supplies and IGST is to be paid along with basic custom duty. The receiver of goods or services is liable to pay the tax to the government as the seller of goods resides outside India. But receiver can also claim full IGST paid on the import of goods. So IGST is interstate transaction, but you can claim full ITC on the tax paid by the dealer. Next is reverse charge mechanism, RCM. Reverse charge can be termed as a mechanism in which liability to pay tax shift from supplier of goods to the recipient of goods. Basically, the purchaser of goods need to pay tax to the government under certain conditions as covered under the reverse charge mechanism. Under reverse charge, basically the tax is to be paid by the receiver of the goods. We have a full-fledged chapter on reverse charge mechanism under this series of GST videos. We'll discuss it in detail there. Next is e-way bill. E-way bill is an electronic way bill for movement of goods which can be generated through e-way bill portal. E-way bill is applicable for movement of goods for any purpose, be it B2B, B2C, export, stock transfer, import or job work. Basically, for central transactions, any B2B, B2C transaction exceeding INR 50,000 is applicable for e-way bill. But in case of local transaction, every state government has set its own different rules. So for local transaction, there are different rules in different states. But for central transactions, if any B2B, B2C transaction is exceeding INR 50,000, then it is eligible for e-way bill. Again, we have a full-fledged chapter on e-way bill in this series where we will discuss it in detail. Next is e-invoice. E-invoicing is a system in which all invoices, be it B2B, debit credit note, SEZ, export, except B2C invoices are electronically uploaded and authenticated by the designated portal. A unique invoice reference number is generated for each invoice by Invoice Registration Portal, that is IRP, on successful authentication. Along with IRN, each invoice is digitally signed and added with QR code. So this complete process is collectively called as e-invoicing under GST. On e-invoicing also, we have a full-fledged chapter in this series where we will be discussing it in detail. Under this chapter, we have discussed the basic concept of GST and the common terms used under GST. At the end of the chapter, we have provided certain exercise. You can view the exercise on screen and attempt it. Hope after going through this chapter, the basic concept of GST and the common terms used under GST are clear to you. Thanks for watching. For more videos, subscribe to our YouTube channel.